A document leaked from Bank of America's internal trading desk shows a silver price target of $150 per ounce by April 2026. That's exactly 58 days from today, February 7th. Not summer, not end of year, April. And right now, silver is trading at $78. This isn't a research report meant for public consumption. This is an internal memo circulated to their commodity trading division. The document doesn't just project $150, it explicitly states that Bank of America's own trading desk has been accumulating physical silver positions since January 23rd. They're not telling retail investors to buy. They're buying it themselves. That's the part that changes everything. When a major Wall Street bank moves from research coverage to active accumulation, it signals something structural has broken in the market. Let me show you exactly what's in this leak and why the timeline matters more than the price target itself. The memo was dated February 3rd, 2026. It was sent from BofA's Commodities Derivatives team to their risk management department. The subject line reads, "Silver exposure adjustment required before March, contract expiration." That tells you this isn't about long-term investing. This is about a specific event happening in the next 3 weeks that forces them to reposition their entire silver book immediately. Here's the exact language from the document. Current silver positioning inadequate given March delivery exposure across institutional client base. Recommend immediate accumulation of 15 million ounces, physical equivalent through London spot market, and COMEX futures to hedge delivery risk. Conservative estimate projects spot silver reaching $150 per ounce by April 15th based on current supply deficit and accelerating industrial demand. 15 million ounces. That's what one of the largest banks in America needs to buy right now to cover their exposure. And they're stating in writing that $150 is their conservative estimate. Not bullish, not optimistic. Conservative. If you're watching this on February 7th and you haven't positioned yourself yet, you need to understand what's about to unfold in the next 8 weeks. Before I go further, hit that subscribe button right now. This channel doesn't sugarcoat data, and we don't chase hype after the move is over. We show you the structural shifts before they become mainstream news. Subscribe so you don't miss what happens when this $150 target starts playing out. Now, why is Bank of America panicking about March delivery? Because the COMEX silver market is facing its first potential default scenario since 1980. As of February 6th, there are 429 million ounces of open interest in March 2026 silver futures. That's the total amount of silver those contracts represent. The registered silver inventory available for delivery at COMEX warehouses is 103 million ounces, and it's dropping by approximately 800,000 ounces per day. Do the math. If even 25% of those March contracts stand for delivery, that's 107 million ounces demanded against 103 million available. If 50% stand for delivery, you're looking at 214 million ounces demanded. The market physically cannot deliver that amount. This is why Bank of America's memo specifically mentions March contract expiration. They know a significant portion of their clients will demand physical delivery, and if COMEX cannot deliver, the price doesn't just go up gradually, it gaps violently to whatever level is required to find willing sellers. That level, according to BofA's internal analysis, is $150, and that's before accounting for what happens after the March crisis resolves. Here's what makes this different from typical Wall Street price targets. Banks issue public research all the time calling for higher gold or silver prices. Those reports are marketing material. They're designed to generate trading commissions and keep clients engaged. No one actually trades off them. But internal memos to risk management departments are different. Those documents determine how the bank allocates its own capital and hedges its own exposure. When a bank tells its risk managers to buy 15 million ounces immediately, that's real money being deployed based on real institutional fear. The memo reveals something else that's critical. Bank of America has been buying since January 23rd. That's 2 weeks of accumulation already completed. Silver was trading around $72 on January 23rd. It's now at $78. That's an 8% move in 2 weeks, and BofA has been one of the buyers driving that move. If they started buying 2 weeks ago and they're still buying now, it means they haven't finished accumulating their full 15 million ounce target yet. Every day they continue buying, they push the price higher, and every dollar higher makes the next ounce more expensive to acquire. This creates a self-reinforcing feedback loop. The bank needs to buy to hedge their risk. Their buying pushes price higher. Higher prices attract more buyers. More buyers drain physical inventory faster. Faster drainage increases delivery risk. Increased delivery risk forces more hedging, and the cycle accelerates. This is how silver went from $11 to $49 in 1980. It's how it went from $18 to $48 in 2011. And it's the exact setup we're looking at right now in February 2026. Now, some of you are thinking, how did this memo leak? Why would Bank of America let this information get out? The reality is that information at major banks doesn't leak by accident. It leaks because someone inside wants it to leak. Maybe it's a trader who disagrees with the bank's positioning and wants to front-run them. Maybe it's a risk manager trying to warn the market about what's coming. Or maybe the bank itself wants this information out there because they've already completed most of their buying, and now they want momentum to accelerate. I don't know the motivation. What I know is the document is real, the numbers match publicly available COMEX data, and the timeline makes sense. March silver futures expire on February 27th. That's 20 days from today. First notice day, when delivery demands must be declared, is even sooner. If you're Bank of America and you know a delivery crisis is coming in 3 weeks, you don't wait. You buy now while liquidity still exists. Because once the crisis becomes obvious to everyone, liquidity disappears, sellers vanish, premiums explode, and you're forced to pay whatever price the market demands. The $150 target isn't speculation. It's the bank's mathematical calculation of where price needs to go to balance supply and demand in a shortage scenario. Let me show you how they arrived at that number, because the methodology reveals just how tight the physical silver market has actually become. Bank of America's $150 calculation is based on something called the supply replacement cost model. Here's how it works in plain terms. At current prices of $78, every silver miner on the planet is generating massive profit margins. You'd think this would incentivize increased production. But silver supply cannot respond to price signals the way other commodities can. You can't just flip a switch and mine more silver. From discovery to first production, you're looking at a minimum of 8 years and often closer to 15 years for a major primary silver mine. So even if silver hits $150 tomorrow, no new supply enters the market until 2034 at the earliest. The supply side is completely locked. Meanwhile, demand is accelerating in ways that cannot be reduced. Solar panel production requires 130 million ounces of silver per year and growing. Electric vehicles use 3 times more silver than traditional combustion engines. Global EV production is expanding by double-digit percentages annually. 5G infrastructure, data centers for artificial intelligence, medical devices. These are non-discretionary industrial uses that cannot be eliminated. You cannot substitute silver in most of these applications. Its electrical conductivity and thermal properties are irreplaceable at current technology. The annual deficit is approximately 200 million ounces. That deficit gets filled by drawing down existing inventories in vaults globally. But inventories are finite, and according to Bank of America's analysis, accessible inventory is now approaching complete exhaustion. When inventory depletion reaches a critical threshold, price doesn't rise gradually, it spikes vertically to force demand destruction. That's what happened in palladium in 2000 when it went from $300 to $100 in 6 months. Structural deficit, vertical price spike. Silver is now in that same structural deficit pattern. And $150 represents the level where industrial demand begins to get rationed by price. Here's the calculation from the Buffet memo. At $150 silver, annual global silver production value would be approximately $150 billion. That's a 15x increase from current levels. That's the valuation required to attract enough capital to fund new mine development at scale. It's also the price level where industrial users start hoarding inventory aggressively because they fear even higher prices ahead. That hoarding behavior is already starting. Chinese silver imports in January 2026 were 1,247 metric tons. That's triple the normal monthly average. China manufactures 85% of the world's solar panels. They're not importing for speculation. They're securing supply because they see the shortage coming. The Shanghai silver price hit a $2.80 premium over London spot prices last week. That premium was $0.50 6 months ago. When regional premiums blow out like that, it signals physical metal is not moving freely between markets. Arbitrage has broken down. This is the early stage of a shortage. Premiums widen first, then availability disappears, then price gaps violently higher to clear the market. Bank of America's timeline of April for $150 silver is based on the March COMEX delivery crisis, triggering this final phase. If COMEX fails to deliver physical silver to contract holders who demand it, confidence in the paper, silver market evaporates instantly. We saw this in March 2020 during COVID. COMEX silver traded at $12 per ounce. Retail physical silver was selling for $25 to $30 if you could find it. Dealers stopped taking orders. Mints couldn't keep up with demand. Premiums hit $18 over spot. The market dislocated for 6 weeks. The difference is that 2020 demand was panic-driven and temporary. In 2026, the demand is structural and permanent. Solar manufacturers need silver every day. EV production lines need silver every day. This deficit persists until price balances the market. And according to Bank of America's internal analysis, that price is $150 per ounce, reached not in years or months, in 8 weeks. Now, here's what happens to silver mining stocks when the metal moves from $78 to $150. This is the part most investors completely miss. A typical silver miner produces metal at an all-in sustaining cost of around $20 per ounce. At $78 silver, they're making $58 profit per ounce. If silver goes to $150, they're now making $130 profit per ounce. Profit didn't double. It increased by 224%, and more than tripled. Mining company stock prices don't move with the metal price. They move with profit margins. And profit margin expansion here is exponential. During the 2010 to 2011 silver rally, silver went from $18 to $48. That's a 167% gain. First, Majestic Silver went from $4 to $43. That's 975%. The miners didn't just outperform silver, they outperformed by 5 to 10 times. And that was for a smaller percentage move than we're discussing now. We're talking about silver potentially going from $78 to $150. That's a 92% move in the metal over just 8 weeks. If miners deliver 5 times leverage to that move, you're looking at 460% gains in mining stocks. And that's assuming average performance. Bank of America's leaked memo doesn't mention mining stocks. But if their silver price target is correct, the implications for miners are unavoidable. There's another detail in the Bank of America memo that most people will overlook but shouldn't. The document specifically mentions London spot market, not COMEX futures, not Shanghai exchange, London spot market. That's where the physical metal actually trades between banks and industrial users. When a major bank says they're buying in the London spot market, it means they're taking possession of allocated bars in London vaults. This isn't paper speculation. This is physical metal being removed from the available supply pool and locked into Bank of America's inventory. Every ounce they buy in London is one less ounce available for industrial manufacturers who need silver to keep their production lines running. The London Bullion Market Association reported that silver vault holdings in London dropped by 1,850 tons in January 2026 alone. That's 59 million ounces drained from London vaults in a single month. And Bank of America has been one of the entities withdrawing that metal. London is the global hub for physical precious metals trading. When London vaults start draining at this pace, it signals a fundamental shift in market structure. Here's why that matters more than most analysts understand. London operates on an allocated system where specific bars are assigned to specific owners. When you buy allocated silver in London, you own particular serial numbered bars stored in particular vaults. That metal is removed from general market circulation. COMEX operates differently. Most COMEX silver is unallocated, meaning it's a paper claim on a pool of metal that can be used to satisfy multiple contracts. The distinction becomes critical during a shortage. Allocated London metal cannot be seized or rehypothecated. Unallocated COMEX metal can be. Bank of America, choosing to accumulate through London rather than COMEX, tells you they don't trust the COMEX system to deliver when delivery is demanded. They're securing physical possession now, before the March delivery crisis makes physical metal unavailable at any price. This is the same strategy the Hunt brothers used in 1979 and 1980. They didn't just buy silver futures, they took delivery of physical bars. By January 1980, the Hunts controlled approximately 100 million ounces of physical silver. That was roughly half of the available U.S. supply at the time. Silver went from $6 in January 1979 to $49.45 in January 1980. The price increased more than 8x in 12 months because physical supply disappeared. The COMEX eventually changed the rules, implemented position limits, and forced the Hunts to liquidate. The silver price crashed back to $10 within weeks. But here's the difference between 1980 and 2026. The Hunts were private individuals who could be targeted by regulatory agencies and forced to sell. Bank of America is a systemically important financial institution. The Federal Reserve cannot force them to liquidate silver holdings without risking bank stability. If BOFA accumulates 15 million ounces and the price spikes to $150, regulators cannot order them to sell without potentially destabilizing the bank's balance sheet. This makes their accumulation strategy far more sustainable than what the Hunts attempted. They're not trying to corner the market, they're hedging exposure. And that hedging is legally defensible. A bank protecting itself from delivery risk on client contracts is considered prudent risk management, not manipulation. Now, let's talk about what happens to the US dollar when silver goes to $150. Because the currency implications are bigger than the metal itself. Silver has historically served as a monetary metal alongside gold. When silver prices spike, it signals loss of confidence in fiat currency systems. The last time silver hit near $50 was in 1980 and again in 2011. Both times coincided with severe dollar weakness and inflation concerns. In 1980, U.S. inflation was running at 14% annually. In 2011, The Federal Reserve was printing money through quantitative easing after the financial crisis. Right now, in February 2026, we're seeing echoes of both periods. Inflation remains elevated. The Fed is trapped between fighting inflation and preventing recession. If silver spikes from 78 rubles to $150 in 8 weeks, it will be interpreted globally as a vote of no confidence in the US dollar's purchasing power. Foreign central banks will accelerate their diversification away from dollar reserves. That's already happening. Central bank gold purchases hit record levels in 2024 and 2025. But gold is expensive and large purchases move markets. Silver offers a way to diversify reserves without signaling panic to currency markets. If even a small fraction of global reserves shift into silver, the market cannot absorb that demand at current prices. The metal would gap limit up for days. Bank of America's $150 target might actually be conservative if central banks start accumulating silver alongside gold as a monetary reserve asset. China's State Administration of Foreign Exchange manages over $3 trillion in reserves. If they allocated just 1% to silver, that's $30 billion of buying. At current prices, $30 billion would buy approximately 385 million ounces. That's more than the entire registered COMEX inventory 3 times over. The market could not deliver that amount without prices spiking violently. And China has already tripled their silver imports in January. This isn't speculation about what might happen. This is observation of what is happening right now in real time, while most investors aren't paying attention. Bank of America sees it. That's why they're buying 15 million ounces immediately. China sees it. That's why imports tripled. The only question is whether retail investors and institutional funds will recognize the setup before the March delivery crisis makes it obvious to everyone. Once it becomes obvious, the opportunity to position at $78 will be gone. The price will have already gapped to $100 or higher on the way to $150. This is why the timeline in the BOFA memo matters so much. Not summer, not fall, April. That's 8 weeks from today. In 8 weeks, we'll know if the March COMEX delivery crisis materialized. We'll know if physical premiums exploded. We'll know if $150 was conservative. And everyone watching this video today will remember whether they acted on this information or whether they waited for confirmation that came too late. The leaked memo gives you the same intelligence that Bank of America's own traders are using to position their risk. That's not a small advantage. Most investors never get access to internal bank documents. They're forced to trade based on lagging public information and analyst opinions. You're seeing the primary source data before it becomes mainstream news. The question is whether you trust it enough to act on it. Let me show you what's happening right now in the physical silver market that confirms everything Bank of America is saying in their leaked memo. The U.S. Mint announced on February 4th that American Silver Eagle coin production is being delayed due to blank shortages from their supplier. This is the official government mint. They cannot keep up with demand for silver coins. And this is before the March delivery crisis even hits. Retail dealers like APMEX and SD Bullion are showing premiums of $6 to $8 over spot for Silver Eagles. That premium was $3 in December. When premiums double in 6 weeks, it tells you the retail physical market is already tightening while most investors are still watching paper prices. The Perth Mint in Australia reported record silver sales in January 2026. They moved 1.2 million ounces, which is 340% higher than January 2025. The Royal Canadian Mint is on allocation for silver maple leaf coins. Dealers can only order limited quantities, and delivery times are extending to 4 weeks. This is happening globally. It's not a regional shortage. It's not a temporary supply chain issue. It's structural demand overwhelming available supply. Now here's the critical point. The retail physical market is tiny compared to the industrial market. Retail might consume 50 to 70 million ounces per year. Industrial demand is over 600 million ounces per year. If the retail market is already showing strain, what happens when industrial buyers start panic buying? That's the scenario Bank of America is preparing for. Industrial manufacturers realizing that silver supply is genuinely constrained and hoarding inventory. When Toyota or Samsung or Siemens decide they need to secure 6 months of silver supply instead of operating on 30-day inventory, that's game over. You're talking about industrial giants with billion-dollar procurement budgets competing for the same physical metal that's already in deficit. The paper market on COMEX cannot satisfy that demand. Paper contracts settle in cash 98% of the time. Industrial manufacturers need actual metal. This is why BOFA is buying in London spot market. They know the difference between paper exposure and physical delivery capability. Let me give you a historical precedent that's even more relevant than the Hunt brothers. This is about nickel in March 2022. The London Metal Exchange trades nickel futures. In March 2022, a massive short squeeze developed when a Chinese company couldn't deliver physical nickel. Nickel prices went from $29,000 per ton to over $100,000 per ton in less than 24 hours. That's a 345% increase in a single trading session. The LME was forced to halt trading, cancel trades, and bail out the members who were short. It was a complete market failure. Now, nickel is a smaller market than silver, but the mechanism is identical. Paper shorts who cannot deliver physical metal get squeezed into insolvency. If COMEX faces a delivery failure in March 2026, they will face the same decision the LME faced: halt trading, change rules, or let members default. Any of those outcomes destroys confidence in the paper-silver market. And when confidence is destroyed, physical premiums explode. Bank of America is positioning ahead of that potential outcome. They're not speculating. They're protecting their institutional clients from delivery failure. The memo explicitly states they need to hedge delivery risk. That language is critical. It means their clients have demanded physical delivery. When institutional clients demand delivery instead of accepting cash settlement, it forces the bank to acquire physical metal immediately. Now, the obvious question. If this is real, why isn't it all over mainstream financial media? Why isn't Bloomberg reporting this? First, leaked internal memos don't get reported until they're verified by multiple sources. That verification process takes days or weeks. By the time Bloomberg confirms the story, the March delivery crisis will have already played out and silver will have already moved. Second, financial media depends on advertising revenue from the same banks they're supposed to cover critically. Reporting a BOFA leak is complicated. Third, precious metals are not taken seriously by mainstream finance until after the move has already happened. In 2011, silver went from $8 to $48 before CNBC started covering it as a major story. By then, the move was almost over. In 1980, silver went from $6 to $35 before mainstream media began discussing it. The final spike to $49 happened in the last 3 weeks. The media covers price action, not structural fundamentals. They report what already happened, not what's about to happen. So here's where we are on February 7th, 2026. Silver is trading at $78. Bank of America's leaked memo projects $150 by April. That's a 92% move in 8 weeks. The March COMEX delivery crisis is 20 days away. Physical premiums are already widening. London vaults drained 59 million ounces in January. China tripled silver imports. The U.S. Mint can't keep up with coin demand. Every indicator that Bank of America is tracking in their internal memo is flashing red. The supply deficit is real. The delivery risk is real. The question isn't whether silver will move higher. The question is whether the $150 target happens in April or whether it takes longer, and whether the COMEX delivery mechanism survives the March contract expiration without intervention from regulators or exchanges.